another day, another record high for the S&P 500. There's got to be a point where you are at least somewhat worried about valuations.
Not when bond yields are still this low, not when credit spreads are this high. And frankly, in our forecast, we've got a 4,500 year-end S&P 500 target. I don't need the PE to expand to get there. We're going to generate 25% earnings growth this year. So, we'll grow into the multiple. And in fact, we expect the multiple to be flat this year, not necessarily get any more expensive. But when you look at how low bond yields are, when you look at how tight credit spreads are, stocks aren't all that stretched versus historic valuations.
Steve, bond yields are, yes, relatively low, but they're higher than they were 3 or 4 months ago, 5 months ago, yet the markets are at record highs. Take us through the math. I mean, the capital asset pricing model, risk models, interest rates are rising. Why aren't valuations falling?
Because spreads have also compressed. So our work has suggested over the years that it's actually not the 10-year yield or their treasury bond that determines the valuation on stocks. It's corporate bonds. And so, yes, the 10-year has risen, but spreads have compressed. So overall, if you were to look at where the corporate bond yield is today, it would suggest the market could trade as high as 24, 25 times. We don't expect that it necessarily will, but it's consistent with those levels of valuations. You got to look at both spreads and yields.
All right, so if those valuations are somewhat justified, in your opinion, at these levels right now, we are entering yet another catalyst-filled season. Yes, it is earnings season once again. Next week, we've got the big banks kicking things off. What exactly, then, would you be looking for from a fundamental standpoint about stocks and these companies? What are they going to report? What do they need to report in order to maintain this kind of upward trajectory for stocks?
Yeah, look, I think the first and the most important thing is once we get first quarter earnings starting next week, it's going to become apparent very quickly that the earnings recession is over, that we're no longer in a position of having year-over-year earnings declines. Part of that's just the comps from last year. But more importantly, it looks like we're going to start growing earnings this year 25%. And in particular, what we're looking for in this first quarter, yes, but more so even in the second quarter in July, is the value cyclical stocks should generate ridiculously good year-over-year earnings growth. I'm talking 200+%. And we think the relative differential there versus the growth can propel these value cyclicals to one more, really good period of outperformance here over the next couple of months.
I mean, it's all relative, right? This is like the definition of easy comps at this point because things were just so bad last year at this point here. If you take a look at the way that things are playing out, are there places in the market right now that you would key on as being key drivers of that big move? A lot of people argue, and maybe rightfully so, Steve, that the earnings optimism is already priced into stocks that have gone up the way that they have over the last 6 months, especially in value cyclical.
Yeah, I think there's an understanding that these parts of the market are going to do well. I think, there's the old Mike Tyson line, everyone has a plan until they're punched in the face. And so, what's the punch in the face that I think comes this summer? I think this summer is going to be something like a modern day GI's returning home moment in a lot of ways. And so when you look at consumer comfort and even just going to a restaurant, maybe it's 50%. When you look at reopening, there's still several big states, California, New York, that really haven't reopened to the same kind of extent that Florida and Texas may have. And so I think you're going to be surprised at quite how strong the consumer comes back this summer. I think you're going to be quite how strong, how robust earnings and GDP growth is. And I think the market may not have that totally priced in just quite yet.
Really quickly, do you have a favorite sector out there right now?
Anything related to people leaving their home and spending on experiences. So think about things like consumer services, restaurants, hotels, casinos. I know they've run. They're big percentage moves, but they're coming off of a very low base.
Shepard Smith here. Thanks for watching CNBC on YouTube.